Mastercard has been one of the best performing stocks over the last 20 years. Since its IPO back in 2006, its share price has risen almost 8,000%, and the company also pays out a steadily increasing dividend. At the current price, Mastercard has a market cap of $358 billion. It's got $7 billion of cash and investments and $15.3 billion of long-term debt, which means the enterprise value is $367 billion. Revenue over the last 12 months was almost $23 billion. That might seem a little low compared to the market cap, but Mastercard has an incredibly high and consistent operating margin of 55% and a net margin of 42%. As a result, net income over the last 12 months is $11 billion, with roughly the same in free cash flow, and $13.2 billion in ebitda. So right now, Mastercard is valued at 16 times revenue, 33 times earnings and 28 times ebitda. That's slightly above the long-term average of 30 times earnings. In addition, Mastercard doesn't require a lot of capital to be reinvested. CapEx is between $200 to $400 million a year. With so much free cash flow being generated, Mastercard is able to pay a small dividend and buy back a decent amount of shares. Over the last decade, the number of shares outstanding has reduced by 20%, as management has bought back shares every single year, even 2008. So Mastercard is clearly a premium stock, but with that comes a premium valuation. Let's assume the company grows its revenue at the historical average of 12% for the next 10 years, then operates with a 40% net income margin. Net income in 10 years' time would be roughly $28 billion, and a 30 times multiple would put the valuation at $840 billion. Include dividends and the investment return is a little over 9%. That's not a terrible return, but there are risks to consider. A new bill in the US is trying to tackle excessive credit card fees and break up the Mastercard and Visa duopoly. Swipe fees in America average 1.8%, which is much higher than in other countries. In Europe, for example, fees are capped at 0.3%. US lawmakers want to change this and drive more competition in the sector. However, the majority of swipe fee revenue actually goes to the banks. Visa and Mastercard won't necessarily see much of an impact on revenue, and the infrastructure the two companies have built up gives them a strong moat. Even so, increased competition in the space could hurt the long-term outlooks for the stocks, and it's a risk worth watching. Overall, Mastercard is an expensive stock, but its consistent and reliable qualities make it a decent addition to a portfolio. That's why I give the stock a positive rating, but these are my personal opinions, not financial advice, and I've got no position in the stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.